Michael Saylor believes the last 12 months finally revealed what Bitcoin actually is. Saylor says this was the year the world stopped treating it like a side experiment and started recognizing it as digital capital. He argues that every criticism, every so-called flaw, and every perceived limitation turned out to be the property that made Bitcoin work. And once you view it through that lens, the entire landscape looks different. Today, we're going to break down that transformation through 4 sections, each built around a clip from Saylor's latest talk. But before we continue, just a quick reminder that only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Alright, let's get back to the video. When Saylor talks about Bitcoin in 2025, he does not describe a technology. He describes an asset class. He points to a series of events that shifted the world's perception. The political realignment toward Bitcoin, the appointment of pro-Bitcoin cabinet members, the president announcing the intention to become a Bitcoin superpower, major figures like David Sachs describing Bitcoin not as a risk asset, but as a global commodity. According to Saylor, this is when digital gold stopped being a metaphor. He says store of value means capital, and if an asset is capital, it becomes the base layer on which everything else is built. This is where he argues the bugs became features. Volatility revealed value. Immutability created trust, lack of yield prevented corruption, and scarcity created economic energy. Here is how he frames that shift.
I think the emergent consensus in the world over the past 12 months is Bitcoin is digital capital. There were some pretty pivotal events. The Red Sweep was a pivotal event. The appointment of 12 pro-Bitcoin cabinet members was a pivotal event. When the president said we're going to be the superpower, the Bitcoin superpower, that was a critical event. When David Sachs said Bitcoin is digital gold, a digital commodity, the global commodity, it's March of 2025, when he went on television to assert that Bitcoin was special and recognized for its commodity status. That was a pivotal event. And we bandy about, this phrase, digital gold, and people talk about, is it just a store of value? Can it be successful if it's only a store of value? Well, there's a theme to that, which is the bug is the feature. And I think that the humbling epiphany of the past 12 months is every criticism and every bug in these asset classes, in this industry, in the treasury business model, has turned out to be the feature. And here, store of value means capital. Gold is store of value. And if you are store of value, and if you are digital gold, and you emerge as digital capital, then that is a profound paradigm shift for the entire economic world. So why is Bitcoin digital capital? Well, the politicians say it's digital capital. The banks have embraced it as digital capital. Now we actually have we have JP Morgan expressing support for the asset class. We have the head of Charles Schwab that's announced that they're going to custody Bitcoin. They're going to let you trade it. They're going to extend credit against it. They're going to let you deposit it and withdraw it in the first half of 2026. That's extraordinary. So what you see now is 12 months ago, I couldn't get a loan against any kind of Bitcoin posted as collateral from any major bank in the United States. Right now, Bitcoin is creditworthy collateral at Merrill Lynch, at JP Morgan, at Charles Schwab, at Texas Capital Bank, at BNY Mellon, at Wells Fargo, and at PNC.
Coming out of that clip, Saylor's logic becomes easier to follow. Once the world accepted Bitcoin as capital, the comparison changed. It was no longer Bitcoin versus crypto. It was Bitcoin versus the capital assets of the 20th century. Equity, real estate, credit-based collateral, fiat reserves. If Bitcoin is digital capital, then it competes with everything that stores economic energy. And once that framing took hold, the next 12 months evolved faster than anyone expected. If Bitcoin has become digital capital, the next question is simple. Who recognizes it? Saylor argues the answer is now obvious. banks, ETF issuers, public companies, and voters. He says that 12 months ago, Bitcoin was considered toxic collateral. You could not even post it at a major bank for a loan. Today, he lists institutions like Merrill, JP Morgan, Charles Schwab, BNY Mellon, and Wells Fargo. These are among the most conservative, risk-averse entities on Earth, and they have begun treating Bitcoin as credible collateral. Then, there is Wall Street's shift. IBIT exploded from zero to nearly $100 billion. Derivatives built on top of it grew from nothing to tens of billions. Daily liquidity surged into the billions. This is not a sign of a fringe asset. It is the behavior markets show when a new form of capital enters the system. Then he highlights corporate adoption. In 2020, one public company held Bitcoin, then two, then three. By mid-2024, around 30. By the end of that year, roughly 60. Now more than 200 publicly traded companies have adopted Bitcoin in some form. He does not stop there. He claims 700 million people worldwide now identify with the crypto industry. He believes this group influenced the last election, and he argues that Bitcoin has become an economic, technological, and political force rather than simply a financial asset. Here is how he puts it.
You've seen the banks embracing Bitcoin. Now you're seeing Wall Street. Of course, we all know the story of the success of IBIT, the most successful ETF in the history of Wall Street. I've tracked it pretty closely. What's interesting, of course, is it went from nothing to about $100 billion in less than 2 years. But also, if you look at the emergence of the derivatives market on top of IBIT, it went from nothing to $10 billion to $50 billion. And if you look at the liquidity, it went from nothing to trading $4 to $5 billion a day. It's really quite extraordinary. Public companies have embraced this asset. If it's going to be digital capital, someone's got to be able to capitalize on it. There was one company that capitalized on it in the summer of 2020, and then there was two, and then there was three, and we thought that was kind of cool, and then there were 20 and 30. There were maybe 30 at the beginning, the middle of 24, 60 toward the end of the year, and we've gone from 60 to more than 200 in the year 2025. 200 publicly listed companies, up from 60 in 12 months, is quite a bit of progress in a single year. So this is an extraordinary dynamic. And of course, the marketplace itself, right? What we see is 700 million crypto believers. The crypto industry tipped the election last year. It's becoming the most powerful, if not the most powerful, political movement in the country. And it's global phenomena. And if you're going to be global digital capital, then you probably want to rest on liquidity. So you're staring at $60 billion a day of liquidity. But on Friday, I think we had $100 billion trading. So it's an emergent, powerful asset. It's electrically powerful, it's computationally powerful, it's economically powerful, and it's politically powerful. And it's never been more powerful.
The takeaway here is not that everything is solved. It is that the most risk-averse participants in the global economy have already pivoted. They went from rejecting Bitcoin to restructuring around it. Banks now accept it. ETFs now depend on it. Public companies now accumulate it. Voters now demand it. Saylor's claim is simple. This is what happens when an asset crosses the line from speculation to capital. And once that happens, the adoption curve accelerates, which leads to the next question: why does Bitcoin work as global capital in the first place? This is where Saylor shifts from narrative to structure. He explains why Bitcoin's emergence as digital capital is not just a political phenomenon, but a global and technical one. He says most of the world cannot store wealth in real estate because it is illiquid, corruptible, or politically unstable. Most of the world does not trust local currencies because inflation destroys savings. Most of the world does not want to hold assets that can be seized, diluted, or frozen. Digital capital solves that. He also points out that when digital intelligence expands, capital needs to be fast, permissionless, and global. And although he touches lightly on automation, this section is far more grounded than his earlier AI commentary. Here is the cleaner, stronger portion that explains digital capital as a global shift rather than a science fiction scenario.
That observation, Bitcoin is digital capital, is key. We are capitalists. The capital assets of the 20th century: equity capital, real estate capital, credit-based capital. Most of the world thinks private equity, public equity, and real estate is primary capital. The emergence of digital capital is pretty profound because it represents an alternative to people who don't perhaps want to store all their wealth in real estate. As I've said before, there's really no real estate in Africa you probably want to put your family savings into for the next 100 years. There are lots of parts of the world where people just don't want to store their economic energy for long periods of time. So the emergence of digital capital is a global phenomenon. It's also a political phenomenon. It's also a technical phenomenon. And of course, if you pair the emergence of digital capital with the emergence of digital intelligence, you can imagine that in a world with 1 billion AIs talking to 1 billion AIs 1 billion times a minute, they're not going to have a lot of patience for 20th century ways of doing things. They're not going to buy sports teams. They're not going to buy fiat sovereign debt capital. They're not going to store their money in cash. They're not going to trade gold. They're not going to want to store their capital in buildings or cross-trade commercial real estate. They're certainly not going to be comfortable with securities and all of the human and legal and political restrictions that come with them. So the emergence of digital capital at the same time as we have an emergence of digital intelligence is, maybe it's a coincidence, but maybe it isn't a coincidence. Maybe it's an inevitability.
What makes this clip important is how plainly he puts it. Bitcoin is capital for a world that can no longer rely on 20th century infrastructure. It is not tied to local laws. It does not depend on trust. It does not require intermediaries. It is not bound by borders. It moves at the speed of software. If you step back and look at the direction of global markets, the friction points are obvious. Fiat is slow. Real estate is immobile. Bonds are political. Securities are jurisdictional. Bitcoin is none of these things. That is why Saylor argues that digital capital is not an optional upgrade. It is a structural inevitability. And once you accept that, you arrive at the question he believes matters most. If Bitcoin is digital capital, how does it compare to the capital assets people rely on today? Saylor approaches this like a balance sheet engineer. He asks what the cost of capital has been over the last 5 years. The S&P has returned around 14%. Gold has tracked it. He calls that 14% the hurdle rate. He says that money markets might pay 3%. That means you lose 11% of purchasing power relative to capital growth. Bonds can deliver negative real returns. They destroy balance sheets. Then he looks at the Magnificent Seven stocks. They have outperformed the index. Bitcoin, he argues, has outperformed all of them. This is where his argument shifts from philosophy to arithmetic. If a company builds its treasury on assets that underperform the true cost of capital, it is forced to surrender capital. That is why corporations raise dividends and buy back stock. They treat capital as toxic. Holding it destroys value. If a company builds its treasury on an asset that outperforms the cost of capital, it can accumulate capital without being punished. It becomes stronger with each cycle. And that is where he introduces his analogy. He says, companies today are like type 1 diabetics. They cannot store energy. Bitcoin is the insulin that makes storage possible. Here is the section where he lays out that capital hierarchy.
You can see here, in the last 5 years, the cost of capital is 14%. It's the S&P index. Turns out the gold is tracking it. You have two interesting capital assets: metallic capital, gold; equity capital, the S&P index. 14%. That's your hurdle rate. Money markets pay you 3%. Therefore, you're destroying 11% of your treasury assets every year that you hold money markets. Bonds are minus 4%. That's how you bankrupt your bank. The Mag 7's double that number. Bitcoin's double that number. Our company outperformed Bitcoin in the time frame. If your company is capitalized on an asset which underperforms the S&P, then you're negatively polarized to capital. It's toxic to you. So you're going to throw it away as the rational thing. If you're capitalized on a product like Bitcoin that outperforms the S&P, you're positively polarized to capital. You attract money. In fact, the more money you raise, the more profitable you become, the more shareholder value you create. It's a very simple idea. Flip the polarity from negative to positive, and then you just get stronger every single year, and you'll get more powerful. But as you can see, right, the reason that you can't capitalize on the Mag 7 is the SEC 40 Act. And you can't capitalize on the S&P index because the SEC 40 Act. I guess in theory you could capitalize on gold. Interestingly enough, no public company has really done that. And the point that I make to the gold bugs is even the gold miners don't do that. And if the gold miners aren't doing that, then there must be an issue. I don't know what the issue is, but what I do think is the general tendency of corporations is you throw away your money to the investors, and the investors buy the index, and that's how they keep their economic wealth intact. And that's good for the investor, right? That's why Harvard Endowment and Yale and Harvard and all of these large institutions, that's why they have a 500-year life expectancy. They just buy a capital asset like real estate or equity. And the reason that your favorite company lives for 5 or 10 or 15 years and goes bankrupt is because they don't have any assets, right? It's like, again, I've said before, they're like type 1 diabetics, right? They can't store energy. Bitcoin is insulin. It's insulin to the type 1 diabetic, right? If you're a company, you need Bitcoin. It's like your insulin. All of a sudden, you can store economic energy. You're not doomed to decapitalize yourself.
This clip is the closest Saylor comes to a price framework. He does not shout predictions. He does something more foundational. He explains why assets that cannot outrun the cost of capital decay and why assets that do outrun it dominate. Bitcoin's long-term outcome, in his view, follows directly from that structure. If Bitcoin remains the superior capital asset, capital migrates toward it. Companies that adopt it grow. Companies that ignore it weaken. Individuals who save in it outperform. Those who do not fall behind. He is not predicting a number. He is describing a system that reallocates capital toward the asset with the highest energy retention. Bitcoin becomes the gravitational center of that system. Saylor's thesis in this talk is not about hype or price action. It is about hierarchy. Bitcoin is no longer treated as a speculative instrument. It is treated as the strongest form of capital available. Banks accept it. ETFs build on it. Public companies accumulate it. Voters influence policy with it. And global markets move toward it because every alternative leaks energy. He believes the world is crossing into a phase where digital capital becomes the base layer of economic life. If he is right, the shift we saw last year was not a temporary trend. It was the beginning of a structural realignment. And once an asset becomes capital, it does not go back. It becomes the foundation. Bitcoin, in Saylor's view, has already reached that point. And if you want to stay ahead of a market to spot when it's heating up or flashing those rare buy signals, join the Crypto Nutshell, my free 5-minute daily newsletter. You'll get quick, actionable insights and the latest news that actually moves markets, all delivered straight to your inbox every single morning. Just hit the first link in the description and enter your email to join. Thanks for watching.